Break and Retest Strategy, daily consistent wins, while risking only $100 per trade. What if I told you that most traders lose money because they enter too early? They chase breakouts. They buy at the top, they panic during pullbacks, and then they wonder why the market stops them out before moving in the exact direction they predicted. But professional traders, they wait. They let the market reveal its hand first. And one of the most powerful ways they do that is through something called the Break and Retest Strategy. This strategy is simple. It works in stocks, Forex, crypto, options, futures, and the best part, you do not need to risk thousands of dollars. In this video, I am going to show you exactly how you can use the Break and Retest Strategy to aim for daily consistent wins while risking a maximum of just $100 per trade with a strict 2-to-1 reward to risk ratio. That means risking $100 to potentially make $200. One good trade a day can completely change your trading results. By the end of this video, you will know how to identify valid breakouts, how to avoid fake breakouts, where to enter, where to place your stop loss, how to calculate your position size, and how to build consistency instead of gambling. So grab your notebook, because this might become your new favorite trading setup. Section 1. Why most traders fail breakouts. Let us start with the biggest mistake traders make. Most beginners think the breakout itself is the entry. Price breaks resistance, they instantly buy. Price breaks support, they instantly short. But here is the problem. The market knows where breakout traders place their entries, and more importantly, the market knows where their stop losses are. That is why false breakouts happen all the time. Price spikes above resistance. Retail traders rush in. Then smart money dumps the price back down. And suddenly everyone gets stopped out. This is why patience is one of the most profitable skills in trading. Instead of buying the breakout immediately, professional traders wait for the retest. Why? Because the retest confirms whether the breakout is real or fake. Let me explain. When resistance breaks, that old resistance often becomes new support. And when support breaks, that old support often becomes new resistance. That transition is where high-probability trades happen, not during the emotional breakout candle, but during the calm retest afterward. The retest gives you better entries, smaller stop losses, higher win probability, better reward to risk ratios, less emotional trading. And that is exactly what we want, because our goal is not excitement. Our goal is consistency. Section 2. Understanding market structure. Before you can trade break and retest setups, you must understand market structure. This is non-negotiable. A market generally does one of three things. It trends upward, it trends downward, or it ranges sideways. The break and retest strategy works best in trending markets. Here is what an uptrend looks like. Higher highs, higher lows, and a downtrend. Lower highs, lower lows. Very simple. Now let us talk about support and resistance. Resistance is an area where sellers previously pushed price downward. Support is an area where buyers previously pushed price upward. The market remembers these zones, and traders around the world watch them. That is why they matter. Now here is where things get interesting. When price breaks above resistance and successfully retests it, that often signals continuation upward. And when price breaks below support and retests it from underneath, that often signals continuation downward. This is the foundation of the strategy. The market breaks structure, then confirms it through the retest. Think of the breakout as the announcement, and the retest as the confirmation. You never want to trade announcements alone. You want confirmation. Section 3. The exact break and retest entry model. Now let us go through the exact process step by step. This is the core of the strategy. Step 1. Identify a key level. Look for clear support or resistance. The cleaner the level, the stronger the setup. You want levels that price respected multiple times, not random lines. Step 2. Wait for the break. Price must see osos beyond level, not wick above it, not briefly spike through it, an actual candle close. This is extremely important. Many fake breakouts happen because traders react wicks instead of confirmed closes. Step 3. Wait for the retest. This is where patience matters. After the breakout, price often pulls back toward the broken level. This is the retest. If old resistance becomes support, buyers step in. If old support becomes resistance, sellers step in. This is where we enter. Not during the breakout candle, during the retest confirmation. Step 4. Look for confirmation candles. Examples include bullish engulfing candles, bearish engulfing candles, pin bars rejection candles, strong momentum candles. You want evidence that buyers or sellers are defending the level. Step 5. Enter the trade. Now we enter with controlled risk. And this is critical. Never enter without already knowing your stop loss and target. Professional traders plan the trade before clicking the button. Amateurs click first and think later. Do not do that. Section 4. Risking. Only $100 per trade. This next section might be the most important part of the entire video. Risk management. Because even the best strategy in the world fails without proper risk control. Here is the rule. Maximum risk per trade, $100. That is it. Not $300. Not $500. Not, I am really confident in this setup. Always $100 maximum risk. Why? Because consistency comes from survival. Your first goal as a trader is not making money. It is staying in the game long enough to develop skill. Now let us talk about how this works. Suppose your entry is at $50 and your stop loss is at $49. That means your risk per share is $1. If you only want to risk $100 total, you buy 100 shares because 100 shares $1 risk equals $100 total risk. Simple. Now let us say your stop loss is wider. Maybe your entry is $50 and your stop is $48. That is $2 risk per share. Now you only buy 50 shares because 50 shares, $2 risk equals $100. This is called position sizing. And this is what separates professionals from gamblers. Gamblers choose position size based on emotion. Professionals choose position size based on risk. Always. Quick pause for a second. If you are learning something valuable from this video, and you want more trading strategies focused on consistency, disciplined risk management, and realistic trading psychology, make sure you hit the like button and subscribe to the channel. A lot of trading content on mine is designed to sell fantasy. This channel is about building actual skill. So if that sounds good to you, subscribe now and let us keep improving together. Now let us continue. Section 5. The 2-to-1 reward to risk ratio. Now let us discuss the 2-to-1 reward to risk ratio. This is where consistency becomes powerful. A 2-to-1 ratio means, for every $1 you risk, you aim to make $2. So if your maximum risk is $100, your profit target becomes $200. Here is why this matters. You do not need to win every trade to become profitable. In fact, even if you only win 50% of your trades, you can still grow your account consistently. Let us do the math. Suppose you take 10 trades. You lose 5 trades. That is, 5 times $100 equals $500 loss. But then you win 5 trades. That is, 5 times $200 equals $1,000 win. Your net result? Positive $500. Even with only a 50% win rate. This is why reward to risk matters more than being right all the time. Most traders are obsessed with accuracy. Professional traders are obsessed with expectancy. Big difference. You do not need perfection. You need an edge, and a solid 2-to-1 reward to risk ratio gives you that edge. Section 6. How to avoid fake breakouts. Now let us talk about fake breakouts, because they will happen. And learning to avoid low-quality setups can dramatically improve your results. Here are several filters I personally recommend. Number 1. Trade with the trend breakouts aligned with the larger trend tend to work better. For example, in an uptrend, bullish break and retest setups have higher probability. In a downtrend, bearish setups have higher probability. Do not fight momentum unnecessarily. Number 2. Wait for candle closes. Never enter based on emotion during an active candle. Wait for confirmation. The candle must close beyond the level. Number 3. Avoid low-volume breakouts. Strong breakouts usually happen with strong participation. Weak volume often signals weak conviction. Number 4. Do not chase extended moves. If price already exploded far away from the breakout zone, the opportunity may already be gone. Wait for the pullback. Remember, the retest is the opportunity, not the breakout candle itself. Number 5. Avoid overtrading. This is huge. Not every day will produce a clean setup. Some days the market is messy. Professional traders know inability to trade, and honestly, that alone can save you thousands of dollars. Section 7. Best time frames for the strategy. One question I get all the time is, what time frame works best for break and retest trading? The answer depends on your personality, but for beginners, I recommend starting with daily chart to determine the trend, and then go down to a 4-hour chart, 39 minutes, then 15, and then 5. This helps align your trades with broader market direction. Then finally execute your trade on a 1-minute chart. Why? Because you do not want to be spending the whole day looking at the charts. With a 1-minute chart, you could be finished trading in 90 minutes max. Be finished trading by 11 a.m. Eastern Standard Time. Section 8. The psychology of consistent trading. Now let us discuss something most trading channels barely talk about: psychology. Because trading is not just technical, it is emotional. Most traders sabotage themselves through fear, greed, revenge trading, overconfidence, impatience. The break and retest strategy helps reduce emotional trading because it forces patience. You are waiting for confirmation. You are waiting for structure. You are waiting for price to come to you. That alone improves discipline. But here is another important truth. You must detach emotionally from individual trades. One trade means nothing. Seriously. The market is a probabilities game. Your job is not to predict every move perfectly. Your job is to execute your edge consistently over time. Think like a casino. Casinos do not panic after one customer wins. Why? Because they trust their statistical edge over many outcomes. You must think the same way. Risk the same amount. Follow the same rules. Stay disciplined. And let probabilities work over time. This mindset shift changes everything. Section 9. A complete trade example. Let us put everything together with a full example. Imagine a stock has resistance at 100. Price tests this level multiple times but cannot break through. Finally, strong bullish candle closes above 100. Now many traders instantly buy. But we wait. The next candle pulls back toward the 100 level. This is the retest. Price touches 100, then forms a bullish rejection candle. That is our confirmation. We enter long at 101. Our stop loss goes below the retest low at 100. That is a $1 risk per share. Since our maximum risk is $100, we buy 100 shares. Now for the target. We want a 2-to-1 reward to risk ratio. So if we risk $1 per share, our target becomes $2 per share or more. Entry at $101. Target at $103. Simple, structured, controlled, professional. And notice something important. We are not hoping. We are executing a plan. That is the difference. Section 10. Final advice. For consistent wins. Before we end this video, I want to give you a few final pieces of advice. Number 1. Journal every trade track. Your entries, your exits, your mistakes, your emotions, your screenshots, your trading journal becomes your personal trading coach. Number 2. Focus on the process, not money. If you focus only on profits, emotions take over. Focus on executing correctly. The money follows good process. Number 3. One good trade per day is enough. You do not need 15 trades a day. One clean setup with proper execution can be enough. Overtrading destroys accounts. Number 4. Protect your capital. Your account is your business inventory. Protect it, always. Number 5. Stay patient. Consistency is built slowly, not overnight. Trading is a skill, and like every skill, mastery takes repetition. The break and retest strategy is powerful because it combines 3 things most traders ignore: patience, structure, and disciplined risk management. You are no longer chasing candles. You are letting the market confirm direction first. And when you combine that with risking only $100 per trade and maintaining a strict 2-to-1 reward-to-risk ratio, you create a framework built for long-term consistency. Will every trade win? Of course not. No strategy wins 100% of the time. But consistency in trading is not about perfection. It is about discipline. If you enjoyed this video and want more content on trading strategies, risk management, trading psychology, and building long-term consistency, make sure to like this video, subscribe to the channel, and turn on notifications so you never miss future uploads. And in the comments below, tell me, have you ever used the break and retest strategy before? And what market do you trade the most? Stocks, Forex, crypto, or options? Thanks for watching, and I will see you in the next video.